Hi everyone. So in this video, we're going to go over a property that my brother and I bought. It was a small 3-unit deal. It was a property that was actually his first property ever, and I wanted to show him how to look at it, how to make sense of it, how to make money from it. It's a property that we bought in March of 2023, and we ended up selling it in I think it was June, maybe July 2023. So it was a very short-term hold. This was a property where we didn't want to hold long term. That was decided going right into it because it was just a property that was like 100 years old. It was an older property. It needed work. It was raised foundation. The roof had to be replaced, or the roofs, because there's two buildings, they had to be replaced, and we didn't want to do that kind of work to it. And it was just a property that was kind of a pig, right? There's a saying that I learned a while ago. It was to sell the pigs, keep the queens. And what that meant by my mentor was more or less just you put lipstick on the pig, you sell it, you make some money, you move on. There's some properties you can hang on to forever or pass it on to your kids. And there are some properties where you're just going to be in and out, make your money and move on. Of course, this one, when you're in it for 3 or 4 months, there were a lot of capital gains that we had to pay. But at the end of the day, it was still profitable. I wanted to show you how we got there. So to start off, what you see in front of you is a document called the investor worksheet. So this document was given to me by the broker who brought the deal to me. So when he brought this to me, it was in a 2-page, 1.5-page barely PDF that just had a bunch of text on it. There was no cash flow projection, no pro forma, no return calculations, nothing like that. And a lot of times, whenever I get a package that is not put together at the standard of what I'm used to seeing, let's just say I'm used to seeing offering memorandums that are 10, 15, 20, sometimes 50 plus pages. When I see something like this, that's about 1 or 2 pages, right away, it tells me that, okay, this is done by a broker that is not on the 25 to 50 page OM level, meaning that there's probably a possible deal here. Not saying that the bigger packages don't equate to a deal, but whenever I see information put together that is not on a certain level, I dig in kind of hard because I'm like, okay, if it's not showcasing some of the things I'm used to, there's probably something here. So anyway, we started digging in, and when you look at this, it just tells you the basics. It's a triplex, 3-unit. It's a triplex. Units 1, 2, 3. There's a 2-bed, 1-bath, 2-bed, 1-bath, and a 1-bed, 1-bath. Here's what they're paying. Here's what they're going to pay. I mean, it gives you information you're looking for, but it's not in any kind of what's the word? Any kind of structure that you can look at and make a buying decision. If let's just say if this was all provided to me and I had to do some back of the napkin type math and make a decision, I probably could have done it, but it could be kind of risky in a sense where you want to make sure you have a spreadsheet, some sort of system where you run your properties through and make sure that you have all your correct calculations. That way you can make a decision on buying or not, which I'll get to in a bit. You'll see the spreadsheet that I used. Moving on, I'm going to show you pictures of the interior. Here's what we'll do by looking at the interior. As you can see, the property is not beautiful. It's definitely not a queen. Maybe it might not be a type of place that you'd want to live in. It's not your type of thing. But when you're making money with property, it doesn't have to be a place that you will live in. It doesn't have to look like some sort of multi-million-dollar mansion. But it's got to be a deal that makes sense on paper, and you can't let this kind of stuff scare you off. If you start looking at properties where you're like, okay, would I live there or not? Would I open a business there or not? If it's commercial, then it can sometimes cloud your judgment, and that's more or less emotions, right? If you look at something and oh man, it's kind of a piece of shit, you can look at that and be like, okay, what can I do to polish it? What can I do to make it look less of a piece of shit? Let me see here. Here's another unit. I think, see, this one was it was kind of decent. This one was the one where the guy was growing stuff, and I'm not sure what it was at the time. I'm still not sure what it is, but it doesn't matter because it's not ours anymore. And here are some pictures of the exterior. This was, I believe this was one building up front. There's 2 buildings here. One unit is up front. And actually, one unit's on this side, and there's another unit on the other side. Or actually, you know what? I take it back. I apologize. One door is here, one door is here, and there's one unit that is, or one door that's upstairs here. Downstairs, it's really just a carport where they used for storage. It was a type of carport where there was a gate there, and you couldn't really drive a car into there, but that's why they used it for storage. Here's what I was talking about. You can't drive a car in there. Let's say if you open it up and you clean it out, yeah, you could drive your car in there, but in this case, it was just for storage. Here you see a little closer shot of the two units, a little bit of lawn space to do a little barbecuing. Over here, you've got some more green space. Cars are parked there. You could park cars here, but you'd have to pour concrete and all that, and it would just drive up your capex, capital expenditures. Let's talk about what we actually did to this property. Oh, here's one final shot. This was actually the money shot that we used. This is what we used to sell the property. It was the main photo. Hard to find a beautiful photo for this property, but here we have it. Even the mailbox here, this was one of the things that we did. We did a bunch of small things. We might have spent about $5,000 on renovations. We spent another $5,000 on miscellaneous fees, and I'll get to that later when I go over the financials. But here, we threw, some new posts up, some new mailboxes, some numbering. On here, this building was all white when we first got to it. The thing is that all we did was threw in some black trim. There's something about that high contrast of the black trim, and you see the vertical, I don't know what they're called, but we told the painter, hey man, look, paint this black up here, leave everything else white. We didn't even clean up the white. It was actually, you know what? Now that I think about it, you can kind of see it there. That's the original trim. It was white, and then what do you know? We painted it black. See, what is not a big deal, and it was such a cheap paint job, like meaning that it didn't cost. It was like a few $100 to have a guy go out there and do it, but it makes a difference. It makes a difference. There's something about that black and white contrast that was just an easy sell. It was a cheap investment in terms of paint with a high return of, oh wow, look at that cool, modern, new, high contrast black and white building. So moving on to document 3. Here is our closing statement of when we bought it. We bought it March 2024, paid $220 for it. The closing costs with prorations, tax, whatever, it was about $4,600. The extra $20,000 you see there was the broker fee. So the broker made some good money here by just wholesaling it to me and my brother, and I'm okay with that. Always be okay with paying the broker. If the broker brings you a deal and it makes sense on paper, even with their fee, why sweat it? If you charge $20,000, $25,000, $30,000, but you're going to make $100,000 plus on the side, he's bringing you an opportunity. So don't be afraid to pay the broker fees. Always work that into your return. So in this case, bought it for technically, call it $245 out the door is what we're in it for. And here, let's start digging into one of the spreadsheets. Okay. So this was the spreadsheet that was used. We used this spreadsheet. This was the actual spreadsheet used when we analyzed the property up front. These are fake names, so don't even worry about that. But it was on a 12th Street. We got 2-bed, 1-bath, 3-bed, 1-bath, 2-bed, 1-bath, and lease start dates here were whatever. But here's the important part. Here's the moneymaker. I'm gonna highlight this because you want to understand this part. So with any investment, whether it's a 3-unit property, 30-unit property, 300-unit property, if it was a $3 million retail commercial property, whatever it is, you gotta be able to always figure out what is the most rent this property can bring in. If you take nothing away from this video, take that. What is the most amount of money that this property can make? And after that, you got to figure out when would that amount of money be reached. So in this case, you've got 2 units that are month to month, MTM is month to month, and 1 unit ends at the end of the year. So Philip here, he's safe, right? He's good to go. Can't touch his lease. He signed a 1-year lease back in January. I can't do anything with it until December, the end of this year, and I'm not going to wait till then. With these guys here, Jordan and David, they had month-to-month leases in place, which as a buyer, that's what you're looking for. It doesn't always have to be month-to-month. Sometimes it can be something where it's 1 year out, 6 months out. You just got to figure out what if the juice is what the squeeze in terms of the time frame. With this here, with it being month-to-month, I had to look at, hey, what rents are they at today? And what is the most rent that they're willing to pay based on the market. So with the target rents here, we know that it's got some room to go, right? Because this property, I think we analyzed it at. I'll get back to this spreadsheet in a bit. Don't freak out. I will come back to this. Our cap rate was, what was it, 7.5%, right? If you look at, so what is 1250 minus 915? 335, right? 335 times 12, that puts us at $4,000. $4,000 divided by 0.075, $53,000 in value add. All this means is that if you were to raise the rent from $915 to $1,250, you are going to generate an additional $50,000 plus in value. That's how value adds are done, and that's why it's so important to know how much rent can this property generate. Now, that's just for that one unit. That's the 2-bed 1-bath. When you're looking at the 3-bed 1-bath, from $1,250 to $1,450, not a huge increase, $200 a month or $6,000 per year. If you take $6,000 per year divided by 7.5 cap rate, that's $80,000, right? That's insane. So what I'm getting at is that we have $50,000 up here, $80,000 down there. Right away, you can see that the value add is exponential. You can add a strong amount of money onto the value of the property by just looking at right away, like just looking at what the rents are today and where rents can be. It really does show you, hey, there's some value here. So in summary, in terms of rents, we were currently at $39,000 per year in rent. And over here, once we're all said and done, once we raise the rents for these two units, we're going to be bringing in a little over $47,000 per year. So take note that that's not a big bump. You know, $8,000 or so plus minus $7,000. It's not a lot of money that you're trying to squeeze out of the property, but you'll see that it's going to change the value a lot. So this is the analysis of when we bought it. I basically just told myself, hey, look, if we buy this property based on the current income, what's the worst case scenario? If we have to hang on to this, we're going to have a budget. I budgeted $25,000 from day one. Vacancy, I thought some people would move out. It will cost us $6,200 a month to cover costs. If we bought this for $240,000, you're going to go ahead and have a down payment of 30%. And all in all, even with the mortgage payments at the time, interest rate was 6.25%. I calculated that our cash on cash return would be a solid 7.5% if we were to hang on to it. And that's the stabilized yield base. You're walking into that. That is day one income. I don't have to do anything to it. And I'm making 7.5% on my money, cash on cash. Now, going back to when I was to raise the rents, the extra $7,000 or $8,000 per year, if I did that, my return jumps up almost double, almost double, 14.33% cash on cash. And that's all I did there was raise the one guy $200 a month, the other person, whatever, there's $150 a month. And all of a sudden you're at 14% cash on cash. So, and in regards to that, your expenses, they all stay the same except for management. Management is going to go up a little bit because managers get paid based on what the revenue of the property is. But once I went and raised the rents there, my worst case scenario was this. With every single deal, the upside will take care of itself. If you do a good job, you're going to make money. So you always got to be sure that you can live with the downside. And the downside with this was that if I raise the rents and I can't sell this property, oh crap, I'm making 14% per year. So once I realized that, it's a no-brainer. It's like, hey, let's just buy this and figure it out from there. So moving on. Let me go ahead and save that. Moving on. Here was what we sold everything for. So this is what I used to figure out the sales price when I went to go market it. Okay, same type of rent roll and spreadsheet you saw. Now that it is done, because this is now call it a month later, 2 months later when we put it up for sale. The current rents are now $47,400 per year. We successfully raised the rents as needed, and the thing is that we didn't even max it out. We knew that we could get $1,400 for the 2-1 and $1,550 for the 3-1. I mean, of course we didn't know, but we had comps to support it. If we were out in the market selling it and a buyer reached out and was like, "Hey Tony, do you think you can sell? Do you think you can rent for $1,400 here and $1,550 up here?" I would say, "Yeah, of course. Here are all the comps." So the comps supported it. But the thing is, when you're trying to do a project where you're going in and out, and when you're selling something, a couple of things. Number one is kind of just good karma to leave some meat on the bone for the next guy. But also, you don't want to overextend yourself. You don't want to get to the point where you're too pushing it too hard, and you might end up shooting yourself in the foot. It's kind of like being at the casino and you're playing blackjack or something, and you're on a roll, making a ton of money. At what point do you stop? Right? You got to know when it's enough. You got to know when it's time to just stand up and go home. Right? You can't stay there all night. So in this particular case, we raised the rents, but we didn't go all the way up. We raised it just enough to create the value that we wanted to create, and then we moved on. You'll see here too, strategically, we set it up so that the leases would end September 30th, 2023. At this time, it was probably April 2023. And the thing is that, yes, it was strategic for me to do this in order for me to sell it to the next person, so that if they wanted to keep the rents in place or raise it, it will be up to the new owner. Some people will look at this and be like, gosh, Tony, that's so shady. Why would you do that to these poor tenants and yada, yada. But the thing is that as much as I want to be nice to them, we're a business, and you gotta make money. Do I think I'm putting these people in some sort of homeless position by ending their lease in September? No, I'm not, because when October rolls around, they've got the choice to pay the same rent or renegotiate, hire an attorney, get a longer term lease, whatever. It's up to them. I'm not here to baby them, and I can't really think about that. So whenever you're doing things, it sucks. Like I always hear it from not just other investors or other business owners. It's like, hey, if you raise the rents, don't you feel bad? And I'm like, of course I feel bad. Like, everyone's got bills to pay. But when you've got a goal in mind and you're working on a project where you have to do certain things to meet the market, to sell it, then it's only business. That's all it is. Of course, don't do anything unethical. Don't hurt anybody. Don't do anything where you're going to put yourself or someone else in danger or anything like that. But when it comes to business, this is just what you have to do. So looking at the 2-column analysis now, we are going to shoot for a sales price of $399,900. I think we ended up listing it for $425,000 to test out the market. We ended up selling it for $399,900 or $400,000 with a little bit of seller credit. But what happened here was we performed it at $399,900 at 25% down. On current income, the buyer who buys it from us, he's going to be making almost 10% stabilized, and almost 13% if you count in his principal reductions. The value of it, based on this alone, based on this current income, came up to 408. And what I was really selling was, I said, hey, buyer, in fourth quarter, if the leases come up due and you raise it based on what the markets are, you'll be walking into a value add of $550,000. And that's something where it's very enticing. And I think that when we owned it at the time, we almost wanted to be the ones who increased rents to that level and took on that additional profit. But then for that additional profit, we ran into risk, right? We would have had to get into a situation where the tenants left, and we'd have to release it, find new tenants, we'd have to show it, we'd have to renovate the space. It would have taken more work, more time, more money, and it wasn't something that we were willing to do at the time. So going back to the plan, it was like, hey, let's get in, get out, move on. And you got to remember, too, this is summer 2023. Interest rates were going up every few weeks. Everyone's starting to lose their mind, like, oh, my God, what's going on with the market? So we have to be very cautious about how we do things. So moving on, here's our selling HUD. This is what we sold the property for. We sold it for $399,900. There was about a seller credit of about $12,000. And at the end of it all, we went ahead and let me see. I want to show you the P&L. It shows January 1st, but it was just a year to date. Yeah, we sold it beginning of July. And when we bought it on, was it 323? Somewhere in end of March. And here were all our expenses. I mean, you'll see that there was income too. That was kind of the beauty with this property, was that there was an income component while we were renovating the property. So our expenses were $20,000, but because we made $10,000 here, our expenses were really like about $10,000. Sales proceeds $118. You minus out the $10,000 expenses. We made $108,000 gross. And to help you understand the structure of this deal is that we actually used a credit line. That's why it was kind of no money out of our pocket, so to speak. There was a credit line we tapped into, and we used it. So you'll see the mortgage payments here. It was $3,100 for mortgage payments, and that was just all interest. So we had a credit line here, but let's say you're starting out, you don't have a credit line, and you got to use hard money. Don't be afraid to use hard money. If you've got access to hard money, if you did all the math, let's say we had to pay $20,000 or $30,000 of hard money fees to borrow the money, you're still going to make $70,000 or $80,000 on this particular deal. So don't be afraid of borrowing hard money if you really had to. I want to go back and make sure that that I was very clear about something on the rent roll. Basically, this is an important part of the process when you are looking to acquire. If you buy it right, you will make money on it. But if you buy it wrong, you're going to lose money. But knowing how to buy right boils down to just a handful of fundamental things. With this here, knowing where rents are today and where rents can go, that is your moneymaker right there. That's just the one thing you really got to dial into. So when it comes to, if you have to know where rents are today and where it can go, that goes back to what? That goes back to you really have to understand where the rental market is at. So know what every property is renting for, every unit's renting for, what things go for per square foot, how long does it take to get everything rented. You got to be really dialed into that to really know what's going on in that market. If you know the values, sure, that's important, right? But going back to worst case scenario, because if let's say if you can't sell a property and you just have to hang on to it, you got to know what you can collect on rents. And remember how earlier I said that yes, we're not going to raise the rents to maximum value because we don't want to go over the additional risk and hang on to it longer and blah, blah, blah. You don't always have to squeeze out every single dollar of the property in terms of rents. It's okay to rent it for a little bit less. Instead of $1,450 a month, be okay with $1,250 or $1,350 or $1,400. Instead of $1,250, be okay with maybe $1,100 or $1,200 a month. You don't have to squeeze it out because knowing where your boundaries are is very important. So what I'm trying to summarize here is just make sure you know where your rents are and also know when you can get there. If these were leases ending at the end of 2023, I probably wouldn't have bought this deal. I wouldn't have wanted to hold on to it for 6 months and do all this with the uncertainties of interest rates and the market directions and everything else. So if there are month-to-month leases in place, or if for bigger deals, if the leases are 1 year, 2 years, 5 years out, and if you think you can wait, then it needs to be very strategic and you just got to plan it out in terms of holding costs and the whole strategy behind that deal. I've even seen deals where, let's say someone had a long-term lease in place, they'd go in and offer me, hey, here's a few $1,000 or $20,000 or $50,000 for a bigger deal. Can you move out so that I can get this property back? And although you might have to pay a tenant $25,000, $50,000, or even on a smaller scale, $2,000, $3,000 for them to move out, you'll get the property back and you can take that property and do something with it. Because having a tenant there paying low rent isn't going to make you money. You want to get them out, whether it's with the method I just told you about, where some people like to call cash for keys, or lease termination fee. From the landlord's perspective, normally it's the tenant who's doing a lease termination. But if a landlord wants the tenant out, yeah, just pay them a fee and they move out. But don't be afraid to get creative about that. So all in all, guys, what I'm trying to say is that with any piece of real estate you're looking at, know what is rented for today, know what the most rent you can get out of it can be, and know when that can happen, whether it's 1 month, 6 months, a year, or longer. And if there's a long-term lease in place, figure out if there's ways for you to end it early. Sometimes it can be language that's already in the lease. Sometimes it's through some sort of fee, and everything is negotiable. Everything is negotiable. So if there's a tenant in place and they don't want to get out and they're like, oh, I'm staying here, I've got another year here or whatever, just start throwing money at them because money talks, and that's just the reality of it. There's been situations before where tenants or even owners, they don't want to make a move for whatever the reason. But once you start giving them money, they start counting. And when they start counting, they start dreaming. And you want them to start dreaming on what they can do with that money. So anyway, I hope this video was helpful. If you have any questions, please let me know. And thanks for watching. Good luck.